Okay, well, let's go ahead and get started.
Okay.
Melissa's saying that I believe she can hear us, but we're not going to be able to hear her. She's saying mute is not my audio.
No, you can hear me just fine. I just wasn't talking about being muted. I was talking about not being able to hear.
Okay, all right, perfect. Well, let's get started. And Andy, do they have, they don't have access to this if they?
I can send it right now.
Okay, yeah. And so we'll go through my presentation and then you'll get a hard copy of this fairly soon. So
Okay.
I'll introduce myself and then I'd like to hear a little bit about you and we'll talk about some housekeeping and then we'll dive in. So my name is Rob Holt. I've been in banking in Denver for a little over 30 years and have worked with groups in different capacities regarding business startups and semi-mature or teenager type businesses and getting funding. So I've done this a fair amount. I've been in commercial lending for a little over 15 years and deal with these topics on a daily basis as people are looking at borrowing and loan requests and things like that. I'm with North Valley Bank just down the street here from the center and have been there about 5 years and do a lot of credit review and also look at individual requests and things like that. So why don't we go around real quickly and we'll start with our in-person guest here, Mandy. Take it away. Tell us about yourself and why you're here and sort of also what you'd like to get out of this today.
Yes, so my name's Mandy McGowan. I am a financial coach. I'm interested in this topic mainly because I have a lot of clients come to me. I do a lot of financial coaching for businesses, and I get a lot of people coming to me asking me about lending and those types of things, and that's not my area of expertise. So I'm just looking to get some information to be able to share with them and then have possibly a resource to send them to.
Sounds good. Dorothy, you want to go next?
Sure. My name is Dottie. I'm the owner of Dottie's Amazing Scoops. I started putting together my own ice cream business last year, but due to COVID, things kind of slowed down the process. But I was talking to a couple of people in the industry and they said, you know, have you put together a business plan or a marketing plan? Very new to the industry, and no, I have not, because I didn't even know how to begin. Okay. So that's why I'm here.
Okay. And Melissa, I think it was.
Hi, Melissa Roski. I have a company, Accounting Excellence LLC. I've been running that for about 4 years now. But I have several business clients and I'm planning to expand more in that area in business advisory, outsource CFO services. So I just want to be able to provide better information for my clients.
Well, this is great because we have 3 different people with, I guess, different circumstances, different stages, different things. So that's all really good. What I like to do is not just talk, even though I do like to talk, I'm told. But by all means, if you have a question, please indicate. I want it to be, you know, really interactive. And if there is a question or a thought or something that you'd like to talk with about afterwards that's maybe more private, I'll give you my information right now and we can either talk afterwards, you can call me tomorrow. And, you know, even if there's something that's maybe more specific just to your situation, then yeah, we can follow up. So a good number to reach me is 303. I'll give you my direct number at the bank. It's 303-254-6205. And an email is rholt, which is HOLT, at nvbank.bank. So N is in Nancy, V is in Victor, bank.bank. With that,
Can I introduce myself?
yes, please. We have one more.
I'm sorry. My name is Janet Gonzalez. I work here at the Center Alliance Business Assistance Center. This is our center for our community, for the city of Thornton areas. So if anyone needs some help with their business plan, with a workshop, we do a lot of workshops in this business, in the center. We also have business consultants that help you out with the business plan, financial, anything that you need for your business startup. We're here to guide you, to help you out. And if you ever need help, like I said, give us a call and we're here to help you. You can also use our meeting space. We have 3 different classrooms that you can use our meeting space for your meetings. If you don't have an office, you can come here and use our meeting space. We have laptops, Wi-Fi, computers, anything that you can use for your business. And we're here Monday to Friday from 9 to 5. And my phone number is 720-674-3547. And I'm here and I'm gonna pass this to my coworker, Andy.
Hi, everybody. This is Andy Figueroa, Business Outreach Specialist. Thank you so much for joining us tonight. Hopefully you guys learned so many things, so many new things when it comes to applying for loans. Welcome.
Thank you.
So Andy, for our next slide, do I just click here?
Yes.
Sure. Here we go. Okay. So cash flow. A lot of people, I say it's king because cash in your hand is what pays bills, buys inventory. You know, it's not accounts receivable, somebody that owes you money. It's not income. It's not revenue. It is no money that I have actually received. And it's also money that I have to pay out. So when we as a bank are looking at doing a loan, our primary source of repayment, banks want to know, well, how are we going to get paid back? It's not a lot different than if you loaned a friend money. One of the first thoughts in your head would be like, so how are you going to pay me back? When are you going to pay me back? Things like that. There's really only 3 questions that a bank is trying to figure out. And the first one is, you know, can they pay me back? The second one is, will they pay me back? And the third is, what am I going to do if they don't? And everything revolves around those 3 questions. And it's something as a business owner, my comment here, congratulations, your business is growing. My condolences, your business is growing. I think about, you know, businesses that have suddenly landed a contract with the 800-pound gorilla that is Walmart. And a year later, they're out of business because they ran out of cash. They didn't have enough cash to start, the demands for production, things like that. Business was going great. They had lots and lots of revenue, but they didn't have the cash flow that was going to support their business. But they had to hire new people. They had to outsource this, that. Things cost money. And a short-term disruption in cash flow, you know, 1 to 3 to 6 months, most small business owners and even individuals can't withstand that. You know, you've got to have cash. So a lot of our investigation goes around, what is that cash flow going to be like? And most business owners are doing the same thing in a very practical way, saying, okay, I have these bills coming up in 2 weeks, in 1 month, in 2 months. Am I going to have the cash to pay those? And that is essentially that cash flow cycle that we're all looking at. This next comment here about financial statements and projections, I think, Melissa, you kind of touched on that a little bit, that it's really important for the bank to be able to see that, because we're not any better at predicting the future than the weatherman is. And the further out that you look in the future, the less certain you can be. So our best indication of the future is the past, unfortunately, and that's obviously not as reliable as we would like it to be. But if you've been in business for 4 years like Melissa has, that's what I'm going to ask for. Say, well, show me your financials. That gets a lot more difficult for a person like Dottie to say, well, gee, I know I make great ice cream. I may not produce fabulous financial statements. Even the software that's available out there that of course costs money, you still have to know, well, what am I putting in to generate these statements? And that's where, relying on some professionals and getting some help, either, through the Alliance Center or any other source, I think is always a great idea, because it's one thing to be a good cook. It's another thing to run a successful restaurant. There's many, many people that are really good at producing a product, but actually running a business, unfortunately, most people learn how to run a business on the street in the School of Hard Knocks. You can take a lot of business courses, but there's nothing like either growing up in the business, or if you're strong enough and smart enough and quick enough to learn on the job. It's obviously a more difficult path, but a lot of times that's the way it happens. That running a business is a challenge, and it's not just producing a meal in a restaurant or making great ice cream. A lot of it comes down to these financial statements and projections that I want to know, how am I doing? Any business that isn't monitoring how they're doing is probably in for a rude awakening or a surprise. And I like to say I love surprises, but there's a lot of us like, ooh, man, there's a big amount of fear around that. Well, what do you mean? Tell me about the surprise. A lot of times you don't want to wake up and say, wow, I have a bill that's due and I don't have the money to pay it. That would be a bad surprise. So one of the things that we're going to look at is, your financials and also your projections. And one of the things that demonstrates to a bank is that, you're on top of it. You appear to be a fairly competent individual that's thought of these things. And it gives the bank a lot of comfort when our potential borrower is thinking about these things. We'll touch on that, or I'll touch on that a little bit later, about other considerations. And skill of management is a big deal that a lot of people overlook. As a lender, they get enamored and fall in love with the numbers. But really, the difference between a successful business and one that's not usually comes down to either character or their skill of management. And that's a really hard thing to quantify. But when I'm talking with somebody and they start producing, hey, here's my financial statements, here's what I think I'm going to do, to me, that gives me some comfort and an indication that, okay, this person is taking this very seriously. They've gotten some help. They're going to be able to understand some numbers and think about cash flow and things like that. So real quick questions on cash flow and growing the business and financial statements and things like that, or comments even?
I have a quick question.
Mm-hmm.
So I work with a lot of new businesses, and often we see a loss on the profit and loss, but they have cash available. Is it just the profit and loss that's being looked at, or is that available cash also being looked at when they're applying for lending?
It's both. That, the income statement, that, profit and loss, if you will, another term for that, that's an indication of ongoing operations. And that's like, we use that there's a couple methods, but we use that to try to figure out cash flow for the most part. But then there's the balance sheet aspect of it as well, that say, well, what cash do I have? Most businesses that start out, it takes a while to generate revenue and build customers and things like that. So they're going to be using that cash that they have on their balance sheet, their nest egg, and until they can break even and start adding to that pot. Some of the things that we look at are, this break even analysis. Okay, at what level of sales do I achieve this break even, where I'm covering all of my overhead costs, either my fixed costs of, okay, I got to make rent every month, or I've got to pay insurance, or I have to pay one employee. That would be maybe more of a fixed cost, although an employee could be a little variable. And then there's variable costs that also, that move with your level of production. If I'm making ice cream like Dottie, well, my milk and my sugar, and I think there's a little salt. I don't want to, Dottie knows better than I about how to make ice cream.
You're on a roll.
Yeah. But those costs are going to be variable depending on how much ice cream I produce. So
Right.
a financial advisor, someone that's good at those financial statements, you can look in the future and say, okay, if I have $50,000 to start this business, how quickly, another term is like my cash burn rate. How quickly am I going to be able to generate positive cash flow so I'm not just dwindling and my $50,000 is dropping. So at some point, let's say I project within 13 months, I'm going to have positive cash flow and I'm not going to be using the $50,000 that I set aside. And then you can sort of manage to that goal. When we look at sources of credit and where to actually find money, depending on where you are in that cycle, Mandy, will sort of direct us to that. If I'm first starting and I want money, well, then people are going to look a lot more at, well, how much money do you have? What's your skin in the game? If a lender is sometimes viewed as a partner, and they shouldn't be. We'll talk a little bit about that too, about the pros and cons of debt versus equity, because people are going to have different expectations and things like that. But either your partner or your lender is going to want to know that you have something at risk too, that we're all in the same boat, rowing in the same direction with the same goal. That, gee, we want this to be successful. The worst thing that could ever happen for a bank is to have a loan that goes bad. A lot of people think that, well, it'll be okay. The bank's never going to lose money because my collateral is worth X amount. Well, I'm here to tell you, in my experience, it absolutely never works out that way. The bank almost always loses money when a loan goes bad, because whatever collateral that we now own, after probably 18 to 24 months of legal expenses, we don't want to own. I'm not in the ice cream business. I don't know what to do with ice cream equipment. And everybody knows that. So the vultures are going to circle and they're going to say, I will give you 10 to 15 cents on the dollar of what that equipment is really worth, because I know that the bank doesn't want it. So it's a very, very challenging that if a loan goes bad, the bank is ever made whole. So it's in the bank's best interest to have you be successful, to have the cash flow to pay back the loan, and then we do another loan as you continue to grow. And that's a very positive relationship. But if it gets into, hey, this thing's going down the drain, then it's not good for anybody. Is that helpful,
Thank
Mandy?
you.
Okay. Any other quick thoughts or questions on that? All right, hearing none, we'll move to the next one. Debt versus equity. Pros and cons. Debt is borrowing. Equity is somebody that's just putting cash into the business. As an owner, it's going to be a partner, if you will, or part of the ownership group. And lots of different pros and cons there. When someone is loaning your business money, the most that they're ever going to get, if you're wildly successful, is just essentially the interest rate that they're paying, or that you're paying on that money. So let's say it's a 5% interest rate. You're, Melissa, you've grown your business over the 5 years of the loan, and man, your return on your business now is 20-25%. Well, the lender doesn't partake in that. Our margins are really thin. And all you have to do, that's one of the big pros of you as an owner, is that, hey, I took out a loan. And there were maybe some rules around that, some loan covenants and things like that. But all I got to do is pay you your 5%. And if I hit it out of the park, I took the risk. This is capitalism 101. This is the United States of America. I reap the benefits of that. as opposed to if, okay, I have $50,000 and I really need 100. So I find some source where someone's going to give me the other 50, but now we're partners. Well, gee, my partner, if Mandy and I are partners, I'm going to say, great, Mandy, you just made $100,000. Well, I want my 50. And a lot of times the sources for other equity is friends and family. And borrowing money, going into business with friends and family is fraught with danger. I've seen a lot of unhappy Thanksgivings or lack of Thanksgivings. And you may have, you know, friends and relatives that are calling you all the time, asking you, well, gee, Dottie, why are you pricing your ice cream at this? And maybe you should tweak your recipe. And you're like, oh my God, this was the worst thing I ever did. I didn't really want to take on another owner. And there's hurt feelings. And, you know, when pocketbooks are hurt, hearts are hurt, and relationships can go the other way. Whereas when you have a lender and it's a bank or some other lender, it's a much more professional arm's length deal. You're not inviting them to Thanksgiving. Yeah, there's hurt feelings, but it's a business relationship. And if things don't work out, then things don't work out, you know.
Exactly.
Not to minimize that, but at least you're not losing lifelong
Family over it.
Yeah, absolutely. So what most people do is a balance of some kind. That if I need $100,000, maybe I personally have 50. Maybe I can borrow 40, and I bring in a minority partner, and we have a real I'll call it a prenuptial agreement. You know, that when you're partners, I remember taking a class one time, you're married, and not every marriage works out. So you ought to have a plan about, well, what if this doesn't work out? How are we going to unwind this marriage/partnership? That is money well spent up front. Because if everything ends up in court with a partner, it's just like the scenario that I described of going into court with your lender. It's a long process, and it's expensive, and probably not a happy resolution for anyone involved. You can win the battle and lose the war. You know, congratulations, you won. But nobody ever really got their money back, and nobody's getting invited back for Christmas. And I'll never speak with you again. You know, things like that are unfortunately very common. So some advice up front, getting things in writing about how this is going to work is a very, very, very good idea. And what the right balance is for somebody. Most people, when you're starting out in business, it's a matter of necessity about what's available. You know, we don't sort of live in a fairyland where you say, well, I'm going to pick and choose this and that, and here's how I want it to be. Well, there's lots of things that we want to be that just aren't possible or don't seem to happen or work out. So I read that I think something like 50% of people that start their businesses do it with their own funds and their own credit card or their own home equity. They just figure out a way to get it done until they get, you know, 1 to 2 to 4 years in, and then it gets a little more sophisticated. They need some bigger money, and they can have some different funding options and things like that. So what the right balance is and what's actually the way it's going to play out, sometimes there's a gap there. And I think that people, you know, need to have realistic ideas around that. That most people are, they may love you personally, but you find out how much they love you when you ask them for $50,000 and you want to start a business. Absolutely. So most times it comes down to you. And a lot of times I've heard people say, and I personally believe this, that's your best investment. You know how hard you can work. You know what you're capable of. If I had $50,000, what should I invest it in? What would be a better place than myself? So that's not a bad thing. It's just, hey, we need to be realistic that business owners have a lot on the line, as you all know. And it's not for the faint-hearted, as they say. So a good balance between debt and equity, I recommend. and what that right balance is kind of depends. So thoughts or questions on that?
I have a question.
Okay.
Like right now, say I have 40,000. I'm putting in so far. Well, I started with 50,000. I put in about a good 10,000 trying to get started, but now other equipment is needed, and that's another 20,000.
Mhm.
So I'm trying to find ways to apply for either grants or loans, because I don't want to use all my cash on hand. I definitely don't want to involve any family members.
Mhm.
So my question is, financing or going for like personal loan, or a couple of people that are in business said, you're a single woman, you can try for grants. There's money to be had out there, and I don't know any of that. So that's what I'm learning. So I don't know the process of how to go about applying for the grants. Do you have to have X amount of money in your own funds? I don't keep money in the bank. I always am worried, if banks go under, FICO won't take care of the little person like me.
Mhm.
It's a savings that I worked hard for. So, and then the lenders want to see the money in the bank. So how does this all work? Because that's confusing to me, because I was taught you keep the money in the mattress, you get control of your own money. Because if something happens, no one's crashing into your bank account, stealing your money, and stuff like this. So the debt versus the equity, I have some equity, and I just don't know how to go about this the right way.
Well, you're in the right place, Dottie.
Okay.
Our next slide, we're going to talk about that.
Okay.
So thank you for the question. As a banker, I'm so grieved to hear you say you don't put money in the bank.
I'm
But
sorry.
I understand that. No. We need to be honest that, and we can talk afterwards about that, but I
Sure.
completely understand where you're coming from. Let me go to the next slide here. And let's talk about that. Sources. Where can I get some money? There is always a source of money. The question becomes, is it going to be worth it? I can go to a loan shark and get money tomorrow, and it's going to be 40%, and it's illegal, and yada yada. And if I don't pay it back, then my legs are in jeopardy. So we absolutely have to gauge what are the risks here. Is it worth it? What's it going to cost me? And the more successful you become, the cheaper your funding sources become. As a very general rule, the sources of money. Where do I get it? It's either family members. There's a term called hard money lenders, and I'm not sure why they're called hard money, but essentially they're collateral based lenders. And to give you an idea that they're not going to look at cash flow or what your financial situation is. They're just going to look at what's the collateral, and they're going to discount that a fair amount. Say, okay, I have a piece of equipment that's worth $40,000. Someone will come out and look at that and say, I'll loan you $20,000 on that. It's going to cost you maybe into the tune in today's world, 10 to 12 to 14% in interest, because they haven't done all of the investigation and they're not looking into it. So they figure, well, there's a greater chance that whoever owns that equipment is not going to be able to pay me back, and I'm going to have to go find it. I'm going to have to repossess it. I'm going to have to sell it. So they take a pretty big haircut on the amount that they're willing to loan you. and they're called hard money. And the benefits of that is super quick turnaround time. They'd be like, yeah, I know that equipment. I can get you money in 4 days. The con of that, but it's going to cost you 14%. But certainly a very viable option. The other option is a bank. It's going to do much more of an investigation. They're going to charge you a lot less. And without even, in addition to the rate, a big thing to think about is what are the fees? You've really got to look at the whole picture. That a hard money lender may charge you 2% of the loan amount upfront, and maybe 1% or 2% when you pay it off too. There can be a lot of fine print going on here. There could be prepayment penalties. They could say, oh, by the way, if you don't stay in this arrangement for the next 3 years, you owe me another 1% point. So hard money lenders tend to do very well. Their costs are expensive because 20% of the loans they do are not going to get paid back. So they have to make up for their costs and things like that. The more traditional bank route take a little bit longer, much more affordable, probably better terms, but more difficult to qualify for because we're going to do that investigation. One of the most successful and well-run programs that the United States government has ever rolled out is the SBA, the Small Business Administration. Our bank does not do a lot of that. That there's, when the government's involved, there's a lot of rules, there's a lot of paperwork, but it's the United States government saw that there was a need, that real job creation and the driver of this economy is small business, small to mid-sized business. The overwhelming majority of people that are employed in the United States work for a small business. Once a business gets above a certain size, it becomes a lesson in or an exercise in efficiency. And they don't really create or produce or innovate. They're just getting leaner and leaner and leaner. And real thriving economies have a lot of small businesses. And the United States government saw, well, how can we help small businesses? Because banks said, well, sure, we love to loan money, but the risks are incredibly high for a small business that's just a startup because we don't have a track record or a history of success. So banks that loan through the SBA steps in and guarantees money. Not all of it, because they want you, the borrower, to have some skin in the game. They want the bank to have the skin in the game, but maybe they'll say, look, we'll guarantee that loan up to somewhere between 50 and 85%, depending on the program, to really encourage banks to loan to small businesses. So when you're in a startup phase, that is a very good option to get an SBA loan. Perhaps an even better loan is something that you touched on as well, Dottie, and not actually a loan, but a grant. There are tons of programs, and it takes work and research, but there are resources to help you find that, because it can be a daunting task and a real challenge. And fortunately, there's people like Alliance and other organizations with the city of Thornton, the state of Colorado, the county, things like that, where you can be granted the money, meaning you do not have to pay it back, because it's in everyone's best interest from a community standpoint to have successful businesses that thrive and hire people and lives get better and all of that. So there's lots of grant type organizations out there. And you're wise to look to someone to help guide you through that process, because one of your questions, or part of it, was, what does that look like? And I would say they're not all different, but they're a lot different. Some of them are, okay, I want to buy that equipment. I'm going to want you to have half of your money in, and then we'll grant you the money for the other half. Some are more, I want you to have a quarter, 25% in, and we'll do 75. Some are just say, you know what, we'll help you do it as long as you can stay in business for 3 years, and you got to document that. Or so the rules for grant type programs are all over the board, but absolutely worth looking into, because the beauty of a grant is if I meet certain conditions, I don't have to pay it back.
Yeah.
And I hate to say free money, because you're going to have blood, sweat, and tears in it for sure. but not interest rates, not fees, things like that, typically with a grant type program. So those are a lot of different sources, and you have to look at what's it going to cost me, what's my best source, and that's a great place to get some advice. That I get very nervous. I'll go on a tangent here for just a second. That when I'm talking to a business owner and I start asking them who their advisors are, and they say, I don't have any advisors. I'm Jesus Christ. I walk on water. I'm an expert at everything. And I'm like, oh, pleased to meet you. There's no one human being that can be an expert at everything when it comes to marketing, bookkeeping, accounting, legal aspects. How do I find money? Mentorships. Is there someone that's done this business or has been in business for 10 years that I can call up and ask questions with? Mom, dad, cousin, anything like that. I feel much more comfortable when the stool they're sitting on has 3, 4, 5 legs versus, hey, it's just me. That's a much greater risk to your success in business. Dottie, were you say something? Or is that you, Melissa?
No, no, I agree.
Yeah, and a big resource for you can be some of these organizations that help you navigate this thing. Is like, I need some money to buy this piece of equipment. How can I do it? Another source is equipment manufacturers. That they learned a long time ago. When I go buy a car, well, GMAC and Ford Financial and Toyota, they want a piece of that pie too. They're like, well, why don't you just let us loan you the money? And it's like, maybe that's a good idea. And that flows over into other like equipment manufacturers that they want to sell their product. And the more that they can help you buy their product, the more product they're going to sell. So they may offer financing. And sometimes it's not the most attractive financing from a rate and a term standpoint, but sometimes it's the only option, or it's a pretty good option that they're going to say, look, we're going to give you 7 years to pay this thing back. Whereas the bank, or even with an SB enhancement, they'll say, we want you to pay that back in 3 years. So sometimes manufacturer financing is a very good option when it comes to a piece of equipment.
Some of them are not offering financing. Yeah. So
Some do, some-
Emery
yeah.
Thompson is not offering it. They've been in business since like 1930, over 100 years or whatever, and they don't need to. So unfortunately, they're not.
Oh yeah, and sometimes they want to get into what they call their core competency. They're like, we're real good at making equipment. We don't want to be the bank.
Yep.
People like Ford and Toyota, they're like, we absolutely want to be the bank. So
Yes.
it depends. Yeah. But questions to ask when you're looking at a piece of equipment. Do you offer financing? And if they say not only no, but heck no, he's like, okay, I'll mark that off my list. We got to find something else. So
Yeah.
Any general thoughts or questions or comments on where do I find money?
I have another question, if you don't mind.
I don't know. This is for you all.
Okay, so you have a personal loan versus a business loan. I don't know the difference of how we get to a personal loan or a business loan, which one is beneficial, which one involves, I don't know. How do we get to decide which is best for us to go into borrowing money from a bank?
Okay. Well, good question. That the difference between a business loan and a personal loan is not much when you're a startup. That
Okay.
most of the underwriting or the investigation that is going to go into that comes back to the person. And they're absolutely going to ask you to sign. One of the big differences is, well, will it report on my credit report? A personal loan, almost always yes. A business loan, usually not. But when it comes to who's going to be responsible for paying it back, it's going to be the business and it's going to be you. Unless you're Adolph Coors and Company, I guarantee you the the Coors family is not signing on debt for Adolf Coors and Company. But maybe when Adolphus or whoever it was that started that company, he probably did. He had his name on the line. But when you get to a certain size, they quit asking you for your personal signature. But that's a big number. The terms can be slightly different. It's usually purpose driven. When from my side of the desk as a banker, if it's a business purpose, I have to call it a business loan. But that's not really going to look that much different to the borrower. For me to get a 30-year mortgage to buy a house, that's a consumer loan. And that almost never happens in the commercial world. There are tons and tons of regulation and rules and protection for the United States consumer. Not so much in the business world, that the US government figures either you're smart enough or crazy enough to start a business, you should understand the risks. You're on your own. So business lending is a lot more wide open and a lot more negotiable. Whereas consumers need to be a consumer loan is very black and white. Either you qualify or you don't. And there's rules around how much you can charge and everything. You cannot have disparate treatment, they call it. You can't discriminate. You can't do any of this. And you can't do that in commercial lending either. But at the same time, the lender has the right to say, hey, this appears to be a riskier deal. I think that I should charge 7% versus something that is not as risky. I might charge 4%. You can't really do that in the consumer world. The commercial world, all bets are off. It's very much, you should try to negotiate absolutely every point in a commercial loan.
Okay.
The consumer world is like, hey, take it or leave it, man. Kind of a thing is what it is. Does that help?
Yes.
Most people are, this might shock you, are not really honest with their banker. They'll probably come in and say, I'd like a personal loan for $20,000. And that money may be going to fund a business and the banker never knows, They just say, hey, I want a line of credit on my house. And then it becomes that. So other questions?
I
know
have a
we're getting-
I have a question really
Okay.
quick. Why is it so hard to get a business loan for a small business? And this what happens with me, my experience that I wanted to get a business loan
Mhm.
and then they wanted me to have money in the bank to cover the business loan and more. And I was like, well, that's why I'm asking for a business
Yeah.
loan. So they said, well, it's better to get a personal loan or equity loan in your
Yes.
house. And I go,
Yes.
but I don't want to do that. I wanted to get
Yeah.
a business loan. So they like, no. So they want me to have money in the, so that's what I don't understand. Why
Yeah.
is business loans out there that for the first time you can't qualify? It's very hard for you to qualify if you
Well,
start
yeah.
a business.
Yeah, it is.
And that was like what I was asking.
Okay.
If I have cash on hand, but I don't keep it in the bank, but when you go for the loan, they want to see that you had cash in the bank. I
Yeah.
don't,
Well, and that's the old Mark Twain joke of, a banker's someone who loans you an umbrella when the sun is shining, but not when it's raining. Kind of a thing. It's like, good Lord, I don't, I'm super rich now and I got tons of cash and now you want to loan me the money. And it's a matter of risk that when you have a private finance company that, we all got together, we all threw $10,000 in the pot and we said, let's go out and loan some money. Well, there's not a lot of regulation around that because if we get burned and people don't pay us back, it was just our money. Well, but banks, they have this fiduciary responsibility. They're not playing with their own money. They're playing
No.
with depositor money. So
investors.
they need to be super careful. So they're trying to mitigate risk. They're saying, okay, if you're a startup business, I don't have a lot of confidence that you're going to be successful for the next 5 years that I'm loaning you money. So I want you to have lots of money. That would mean less risk to me. And that's where the SBA comes in because you get this chicken and egg and rock and hard place type thinking and say, wait a minute, people that are starting a business need money and banks aren't necessarily willing to take that risk. So let us step in and we'll guarantee that to a certain degree to make banks comfortable with the risk. You're going to need to have some money, but not all the money. So you would need to find a bank that has a big SBA department. And an important thing about the SBA, the SBA is not loaning their money. it's not taxpayer money. They're an insurance company. It is the bank's money that gets, well, yeah, it's the bank's money, the bank's funds that get loaned out. So the bank has to first recommend, yes, I think we should do this loan. And then the SBA says, yes, I agree. I'll be the insurance company and pay you if they can't pay. So you still would have to have a really good package, and a good SBA lender is going to help you to say, here's the 9 forms. Let me walk you through this process. But when you're starting out, it's a great idea to talk with an SBA lender so that you get around that they're still going to want a lien on your house. They're still going to want you to personally guarantee because the insurance company, the SBA plays real nice until you go and call on that guarantee. And then our experience has been the SBA is going to look at that file for like 3 months and try to see if the bank made any kind of mistake. As an insurance company, they do not want to pay out on that thing. And rightfully so. They say, wait a minute, if you made a mistake, the US taxpayer is not going to bail you out there, bank. So banks are still cautious with SBA, but not nearly as cautious if you just walk in and say, hey, I want to do a commercial loan. To do a personal loan, it's less risky if you have a W-2 wage type job, you've had it for 10 years, or you've been in this industry for 10 years. I have a much more reasonable belief that you're going to have the ability to work and make income to pay back that loan, as opposed to, gee, I woke up this morning, I'm going to throw all that aside and I'm going to start a business, even though I've never done it before. You'd be like, wait a minute, man, you know. So that's the rationale. I do get some of that frustration. The SBA is a great fix for that.
Okay. Thank you.
I'm going to go fast on this last part because we're running out of time. Let me skip ahead here, not skip ahead, but next slide. How to get a lender to yes. That is a great question. A good lender will not just say no, they'll say not yet, not now. Here's what a yes looks like. And a lot of times it's a 1 to 5 year plan. And when I say plan with the stakeholders, this is anybody that's involved or interested in the business. You know, that could be your accountant, because your accountant, and I don't want to speak for accountants here, so Melissa, jump in here. I think one of the things that they can do is minimize taxes, but banks in particular rely a lot on a tax return because the IRS has punitive powers that a bank does not. If there's something wrong with the taxes, the bank can't fine you or charge you a penalty, but the IRS can. So we feel there's a more enhanced incentive to be honest on a tax return. But a tax return does not necessarily accurately show cash flow of a business, success of a business. It's primarily a method and a tool to collect taxes. Most small businesses don't start out with, gee, I'm going to get CPA audited statements. That's expensive, man, you know. But to talk with whoever's doing your taxes and say, look, 2 years from now, I want to buy a building, or I have these, I want to get a loan. The bank is going to look at that and say, well, I need to look at your tax return and know that you're profitable, because that's the primary source of what I'm going to use to try to figure out cash flow and ability to repay that debt. So you may have to pay a little bit in taxes because I know in 2 years I want to get a bank loan. So the communication between the banker and the business owner and the CPA and an attorney and other owners and things like that about what is my short to medium to long-term plan regarding how am I going to get financing, capital to grow my business. All those stakeholders need to be working towards that same goal. And sometimes that's a 1 to 3 to 5 year process so that the financials get to that point where the lender says, yes. It's hard to change that from 1 year to the next. A lot of times it's a process. That's what I mean by realistic timeline. That team of experts, everyone needs to know what the goal is. How do we get there? What is that yes going to look like? My next slide, I'll talk about that yes. The 5 C's of credit. This is something that came out in the 40s and 50s, and it is a time-honored and very time-tested methodology about what does a yes look like on a loan application? These 5 C's, you have capacity, or that's cash flow, which answers that one question. Can they pay me back? Is there going to be, do we believe there's going to be cash flow that can pay back this loan? Collateral, that's more, what am I going to do if they don't? If the borrower doesn't pay it back, well, then I have a secondary source of repayment. Can I go and possess that collateral and sell it and hopefully get some or all of the loan paid back? The next one is character. That's huge, mostly driven by the credit bureau. You know, if you know that you're going to borrow money and you pull your credit and it's not good, that's going to make lenders very hesitant to loan to you, because you're going to say, well, gee, you had these other obligations that for whatever reason didn't get paid. Doesn't give me a lot of confidence that you're going to pay mine. And the credit bureau is not always a great gauge of character, but it's frankly just about the only one that a bank has, and that is uniform and purports to be applied fairly to everybody. So that is the primary tool that a bank is going to use, is what's your credit score?
What is the score? Can I ask you, what is the score that banks do consider?
It depends. Some banks, your larger banks, it either fits in a box or it doesn't, and they're an exercise in efficiency. Your smaller community bank is going to look more into the details there, and depending on which credit report that you're looking at, and even then, sometimes every couple of years, the credit bureaus may decide to change the criteria. So there's a shift. But you know, in general, your highest scores are maybe at 800 or above. I think the best credit score you can have today is like 825. I've never seen one. I've seen a couple above 800, but that would be maybe your top 5% of every borrower in the United States. You know, scores that start to get into the low 700s, 600s, 500s start to get real scary for a lender. I would say your average, your middle of the road is maybe 750.
Okay.
Kind of a deal. But a lot of times they're looking for a pattern. You know, is it widespread? Is it egregious where there's 60, 90-day past due stuff? Are there collections? Are there judgments? That's a lot different than, okay, I had one bill that's a medical bill for $250 that was sent to collection, but I paid everything else since the time I was born. Well, that doesn't appear to be a character issue. That appears to be the medical industry that probably billed somebody and they never even knew about it. It happens all the time. And a community bank will look into the real details of a credit report, whereas your larger, more efficient banks are just going to say, oh, not my problem. Your score didn't meet our criteria. So that's the character thing. Conditions, banks' appetites change. Just like any other, you know, there's the perception that a bank is a public institution like your library. Well, no, they're a for-profit business too. They have shareholders and stakeholders, and they need to stay in business just like everybody else. So you may look at, you know, at some points in time, a bank may love doing construction lending. Then they look out on the horizon and they say, we don't think that's a good idea anymore. And we have maybe too much of it, or we just don't want to do it anymore. And that absolutely is in their prerogative. That's the business that they run. So you may have to go down the street and say, well, are you interested in doing construction lending? Another bank say, absolutely. Part of me says every bank is going to want 100% of your business. I do not think that's a good idea, because banks change. It's best not to have all your eggs in one basket. If you could have 2 banking relationships, I would encourage that. It complicates things, but if you're in a pinch or in a bind, one bank may say yes and one bank may say no when looking at the same financial information, because they're looking at conditions, not just the exterior conditions in the economy, but the condition of their bank. Their appetite may change. The last C, I believe, where was I? Capital. And that's your equity. That's what you were talking about, Dottie. How much money is this person putting into the deal? Some banks want to be more conservative. If I'm a hard money lender, and I'm not looking at anything else, I'd be like, I want you to put 40 or 50% of your money into this deal. If I'm doing more investigative type stuff, it's a general rule of thumb. You better put 20 or 30% of your money into the deal and I'll loan you the rest. So the bank is going to look at all 5 of those C's and then see how they feel about it, start to make a decision. And if you know that, you can plan for that to say, okay, I need my cash flow to be stronger. I need to have decent or acceptable collateral for the bank. What's my credit report look like? Do I have enough cash that I can put my money in? And a lot of times banks say, okay, I want you to put your skin in the game, but I also want you to have some liquidity too, in case there's a hiccup, because it's like organizing a wedding. Something's always going to go wrong. The best laid plans of mice and men kind of a thing. It makes banks more comfortable that you have a cushion. If 1 month there's a business interruption and nobody walks in my door, nobody buys my ice cream, is this borrower, are you, Dottie, going to be able to survive that? And your liquidity is a good fallback for that.
Okay.
Quick questions on the 5 C's.
Collateral. You said about collateral. Are you talking like, say you want to borrow 50,000, are they looking at collateral to match that?
The
Like I have
SBA,
a brand new truck and it's worth 40. I paid 35,000 of that. So I just have a small loan. Is that going to be sufficient for a $50,000 loan that I'm looking for? Like how does the collateral work? Like what percent?
It depends on the type of collateral, depends on the bank,
Okay.
depends on other enhancements that may come to play. I've had great collateral and it turns out we could never be perfected, meaning we could never get a court to recognize that the bank had an interest in that. So that became useless. I've had great collateral that turns out it's in the middle of nowhere. So it's going to cost me $100,000 to go get it.
Yeah.
Okay, that's a mistake. The acceptable collateral to a bank is somebody, am I going to want it? Is someone else going to want it? Are they going to be willing to pay a decent amount for it? Can I get it? Can I possess it? Is it durable? If I have a bunch of collateral that's ice cream, well, I better either eat it or sell it that afternoon. As opposed to a truck. Well, okay, I'm in a metro area. People seem to like trucks. I can maybe advance more on that. The SBA is a great mitigant to a lack of collateral. That is a great enhancement because most people, your collateral is not going to be 100%. If I have a $40,000 truck that I can sell in a retail market, I can't get a $40,000 loan for that because the bank's looking at it. If I end up owning it and I have to sell it, there is no way I'm ever going to be able to sell it for 40,000. I'm going to have to sell it to a wholesaler for 20 because he's going to want to turn around and sell it for 30. So banks start looking at that discount.
Okay.
And it depends on the type of collateral, how old it is, things like that.
Okay.
I have a question. What is the basic type of collateral that they use or they ask for it instead of cars?
Houses are great. People love houses because it's viewed as a very secure thing that at the end of the day, people got to have a roof over their head, somewhere to live. If you look at humankind's basic needs, a house is a big thing. And when people will get in a financial bind and they're striving to make choices about what to pay and what not to pay, they're almost always going to pay for that house, either rent or the mortgage or whatever, because I got to have a place to lay my head at night. So people love houses. Not everybody has a house. So then you fall into automobiles. You get more creative with, durable goods. You get into, pawn shop type things of, is an expensive watch a good piece of collateral? I had a guy one time bring in 5 Rolexes
Wow.
and say, you can have these Rolexes, you can hold them in your safe deposit area or whatever. Can you loan me $100,000 on those? And I looked at him and I said, look, I'm no jeweler. I have no idea. But these things felt suspiciously light. I said, do you mind if we take these to a jeweler and have him look at them? And the guy said, no
Have an
problem.
appraiser?
Yeah, we took him down there and they were the fakest watches you've ever seen in your life. He said, these things are maybe worth 20 bucks a piece.
Wow.
I mean, the guy should have been arrested for fraud. He was attempting to defraud the bank.
Yeah.
So, you know, things that are commonly easily saleable, an automobile is a good one. Most people fall back on either a house or an automobile.
Do they have to have a lot of equity or can it be like no equity?
Equity is a good thing.
But how about if I don't have equity?
Then it's a hard thing
Ah,
because
okay.
banks are looking at a 5 to 10 to 15 year payback period.
Okay.
And real estate is volatile. Most people have grown up in the last 10 years of an economic expansion. A lot of people don't think that anything bad can ever happen to the value of my house. Well, you don't have to look too far back to 2008. About once every decade, real estate drops 20%.
Yep.
And I've never had a borrower come in and say, oh, guess what? The value of my house dropped, so I'd like to give you some extra money to pay down that loan. That has never happened. We've had to make phone calls and say, hey, the real estate value, the collateral value dropped, and now we're in trouble. We're getting regulatory pressure. We want you to come in and pay an extra $15,000 down on the house. And you've never heard longer silences. You know, it's like, no, boy, that's going to be tough. I don't know if I can do that. And it's like, oh, you swore to God that your real estate was great, and now suddenly it's not. So it's a tough position. So they're almost always going to say, I need to plan. If I'm the lender, I need to plan for a 20% drop. And am I still going to get hold? And that's where the equity needs to come in.
Okay. Makes sense.
In applying for a line of credit versus a loan, is there any difference?
Could you maybe handle it? Could
What
you
was
guys hear that?
Oh, sorry.
Hold on. A line of credit versus a loan, the differences. It's a very good question that your financing should really match the purpose. If I have a fixed cost, say I'm buying a piece of equipment that I think has a useful life of 5 years, it would be a bad idea to do a 10-year loan because now my equipment doesn't work anymore and I'm still paying on that dang thing. So a line of credit is a great tool. It's in a couple of ways. That one, you're usually only paying interest only. So monthly cash flow, it's more affordable, less money out of your pocket. There's usually a higher fee for it, and it's usually a repetitive fee that maybe every year, every 2 years, I got to pay a fee to have that option to advance it. But the other pro, if you will, is that I'm not paying interest on money that I'm not borrowing. It's great for variable kind of things, seasonal businesses. Well, gee, you know, I'm a summer business. I do most of my business selling ice cream when it's hot. So I need to borrow money to ramp up for that season. And then by the fall, I'm rolling in the money. I've paid it all back. And I want to be able to do that again next year. But fixed equipment that has a specific lifespan is usually best suited for a term debt. And that helps you build equity that, man, if I can pay off a piece of equipment in 5 years and I know I can nurse this thing along for another 5, well, I'm money ahead. You know, it bothers me as a conservative banker to see people that lease a new car every 2 years. I'm just like, wow, you never owned the car, did you? And if you really look at the cost of doing that, I'm not sure that was the best financial move. But that kind of structure makes a lot of sense of like, hey man, I move every 2 years, or I don't want to own a car. I don't want any expenses. You know, it is a legitimate thing, but I like to own cars for 10 years, for 15 years, because I feel like I got my money's worth out of that car, you know, and unfortunately it's hard to get a 5-year car loan anymore because then it's a $600 a month payment. It's like,
Yep.
ouch. But if I can pay it off in 5 or 7 years and keep that car for 10 or 12, I feel like that was a better use of my money. So line of credit is a great tool for certain things. Term debt is a great tool for other things, usually something that's fixed or finite.
Is there a lot of difference in the application requirements between the two?
No. Differences in rate, differences in fees, because the bank, lines of credit put the bank in a bind that we've made a commitment that you can make a phone call and I can advance X amount right away. So I, as the bank, need to have that available for my borrower. But I'm not necessarily earning any money on it at all because you may not ask for the money for 11 months out of the year. So it's like, wow, So hence you get a fee to cover our costs in a line of credit scenario to say, geez, you're going to have to pay me a 1% fee for the privilege or the ability to draw on that when I need it. So probably a lesser fee over time in a term debt because I have the reasonable expectation that I'm going to be earning some interest on this. I think we're kind of at the top. General questions. I know we've run a little bit over, but thank you, Dottie, for your questions.
Yeah.
Melissa, how do you feel? You may have lost Melissa.
Oh, no, okay. I had to rejoin and I forgot to unmute.
Sorry.
No, I was saying I'm actually working on taxes as I'm listening to you here. So one of my clients' books that didn't know how to do a reconciliation and they swore to me they reconciled every month, and now I'm having to fix 5 years of records. So make sure you do it, get it, have somebody review it your first year, guys.
That's great advice. It's like going to the dentist. If you're checking in with your bookkeeper and accountant a lot, and I know there's a fee associated with that, you can prevent somebody like Melissa having to go back for 5 years. And you talk about a way for your lender to lose confidence in you when somebody comes back and says, oh yeah, you know all that stuff I gave you? Well, it turns out that was wrong. Nobody feels great about that. So I would encourage, check in with people like Melissa early and often. And sometimes a phone call can prevent a lot of damage that is a real problem to undo.
And realize also that there's a vast range in the due diligence that people who do your taxes will do. So, I mean, this client came from a CPA. They never confirmed any of their account balances at the end of the year. That's why this problem exists. So,
Wow.
yeah.
Well, and I forgot what I was going to say. Sorry. Any other thoughts or general questions or for the
So-
benefit of the group?
Can I just ask you again, you touched base on that line of credit.
Mhm.
So the line of credit, do you have to have collateral and stuff for that as well?
It depends on, there's been times in my banking career where banks wanted to do a lot of small business lending, and they realized to do that, they were going to be very credit score driven, where they say you can walk into a bank and get a $50,000 line of credit that's unsecured, no collateral, that's probably evergreen, meaning there really is no requirements as far as revolving that line, or we're just going to do a 10-year line of credit if you have a credit score that meets certain criteria.
Okay.
And I'm not sure if there's banks today that still offer that kind of thing. Obviously, they had a lot of losses with programs like that, but not unheard of at all. The SBA has a line of credit product, smaller things. Maybe they do, $20,000 lines of credit if your credit score is X. And the bank's not going to put a lot of time and investigate more. They figure if you as a human being and an individual have handled your personal financial life in such a manner that your credit score is this, you're probably a good business risk too.
Okay.
So those lines of credit that are unsecured are almost exclusively credit score driven. And they're not cheap, but they're also available and they're unsecured. With usually minimum requirements about how long you've had to be in business, or sometimes they're a one-page application. But that was from my past. Like I said, I'm not sure that that's available today. Some banks are more real estate focused. North Valley Bank is very much a real estate bank because of the ease of collateral. Whereas other banks do a lot of what they call C&I lending, commerce and industry lending. They do a lot of line of credits. And the bigger they get, the more complicated they get, the more reporting is required. But they use more collateral like equipment, accounts receivable, more business assets. Bear in mind, the difference between credit unions and banks is huge. that credit unions used to be that you had to be a member of a group of some kind, and that the credit union industry has changed a lot. And it really, really bothers banks because credit unions don't pay taxes. Credit unions don't invest in their community or necessarily loan in their community the way that a bank does. So credit unions typically, because they're quote unquote not for profit, they're a great resource for borrowing and depositing. They pay a little more on deposits. They charge a little less to borrow. But at the same time, the people that work at credit unions, because at the end of the day, they need to show a zero profit, they pay themselves, their executives receive enormous compensation. And they don't advertise that. And they also don't pay taxes. So when you see a pothole, you can thank a business owner and a bank that maybe paid that too. And there's a big legislative push to say, hey, that was all well and good in the 30s and 40s that credit unions were created to do home loans for people that couldn't get home loans, and say, look, you guys all work in this industry. You all work at this factory. We need to band together so that you can go out and buy a house when banks wouldn't do loans like that. Well, now you have huge credit unions that operate exactly like a bank. So there's a big legislative struggle going on right now where credit unions are actually buying banks. And we're like, well, how does that work? So I would look into a credit union. If they do business lending, it might be a good option. And I would be remiss to say you shouldn't look into every option to find money for your business. And at the end of the day, you need to do what's best for you and your business from a cost and an ease, a provability standpoint. But as a banker, it bothers me because they don't pay taxes. But that's personal. So I'll just put it out there. Yeah, I'm sorry. It's like, oh my God. Yeah. Any other thoughts, questions? You all have my, Melissa, do you have my contact information? Were you able to get that? Were you on yet?
Yeah.
Okay. If something comes up, if you have a client question, if you have anything at all, please give me a call. I will be happy to talk with you. So thank you all so much for your questions and all that.
Thank you.
And
Rob.
thank you for your time.
No worries. Have a great evening.
All right.
Now I want ice cream.
I will have to bring you some. It's alcohol infused.
Oh, I'm a sucker for rum raisin.
Ah,
Thank you. Thanks.
thank you.
I know how to do that. I didn't catch your name. I'm sorry, that's a bad waiter. I asked you right. Carlos? Juan Carlos. Oh. I just lost the little thingamajig. They go in my pocket. Ah. So are